Everyone talks about what to do after a market crash. Sell, hold, rebalance, panic, repeat. But what if the real game is won before the crash even happens? What if the investors who walk away untouched didn't just survive the storm, they prepared for it years in advance? In this video, I'll show you exactly what to do before the next drop hits, so you don't panic, you pounce. In March of 2020, when the world was going into lockdown and the S&P was down almost 35%, a friend called me in a panic. He said, "I'm selling everything." I told him calmly, "I just bought more." He thought I was insane, but the truth is, I wasn't making some bold bet. I was following a process I built years earlier, a checklist, really, for moments exactly like that. Today, he still hasn't recovered emotionally from the loss. Meanwhile, I wasn't lucky. I was prepared. And if you follow what I show you today, you can be too. If you're serious about building long-term wealth and not just chasing the next hype, hit that subscribe button. We make videos like this to help you think smarter, invest better, and stay ahead of the emotional roller coaster most investors get stuck on. Quick disclaimer here. I'm not a financial advisor, and nothing in this video is financial advice. Always speak with a qualified professional before making investment decisions. It's your money, your risk, and your responsibility. The market rewards preparation, not blind bets. Let's kick things off with the first reason most people get crushed by market crashes. They don't have a buying plan. Most investors think a crash is a time to wait and see. But real investors know that waiting without a plan is just fear in disguise. The people who come out stronger after downturns usually had a buying list ready before the fall. They knew which companies they wanted, what price made sense, and what percentage of their capital they'd allocate. And when prices dropped, they didn't freeze. They executed. Think of it like walking into your favorite store and seeing a huge sale. Do you say, "Let me wait to see if prices drop even more"? Maybe. But smart shoppers already know what they want and act fast when value shows up. A crash isn't a cue to guess the bottom. It's your signal to open your checklist, not your news app. Without preparation, the fear becomes paralyzing. But with it, the same chaos turns into calculated opportunity. Remember, you don't rise to the level of your ambition, you fall to the level of your systems. Let's move on to the next factor, emotional framing. The market isn't a monster. Your reaction to it is. When stocks fall, it feels like you're losing control. But what if your perception was the real threat? Marcus Aurelius once said, "You have power over your mind, not outside events. Realize this and you will find strength." Most investors forget that. They assume the market did something to them. But the truth is, the market is indifferent. It doesn't care about your fear or your portfolio. That's why emotional framing is so important. If you see every drop as a threat, you will panic. But if you reframe it as a clearance sale, you're halfway to winning. Studies show that investors who observe the market weekly instead of daily perform better long-term. Why? Less exposure to noise, more mental clarity. Watching your portfolio drop minute by minute is like checking your weight every 15 minutes while trying to lose fat. It's data overload. Reframing your relationship with volatility is not just a mental hack, it's a competitive advantage. By the way, if you're enjoying the video so far and want more topics like this, comment the word "more" so I know. Moving forward to the next key, stop worshiping the Fed. Yes, the Fed's rate decisions move markets. But too many retail investors treat Jerome Powell like a financial deity. One speech sends tech stocks flying, and the next tanks crypto. That's not investing. That's gambling on mood swings. Here's the uncommon insight. In the long run, the Fed doesn't drive your returns. Your behavior does. Historically, even during periods of rising interest rates, disciplined investors who consistently bought undervalued assets outperformed those who waited for the perfect macro conditions. And let's be honest, has anyone ever actually timed their buy around a Fed cut and made a fortune? Probably not. But plenty of people use the excuse of uncertainty to stay in cash too long. Meanwhile, their future was being sold at a discount. The real opportunity lies not in predicting the Fed, but in being prepared for the reaction of others when they do. Because when others overreact, that's your entry point. Now let's talk about the next thing most people get wrong: anchoring to price, not value. Remember when Meta was trading at $88 a share in 2022? People were calling for Zuckerberg's head. Fast forward, and it's over $600 today. Did the company change? Not overnight. What changed was sentiment. And that's the trap. Most people think falling prices mean falling value. But in reality, value often holds steady while emotion pulls prices down. Think of it like a great restaurant with a temporary bad review. The food didn't get worse, just the perception did. And if you're a value-based diner, that's your chance to get in without a wait list. Anchoring to stock prices is how people get fooled. The real game is figuring out what something is worth based on its cash flow, not its chart. Because a stock at $50 could be wildly overpriced, and one at $200 could be a steal. Numbers alone don't tell the story, but fundamentals do. Let's move into something deeper, understanding the cycle behind the cycle. Every crash has a narrative, but every narrative follows a pattern: optimism, leverage, overextension, friction, panic, reset. It played out in 2000 with dot-coms, in 2008 with real estate, in 2020 with COVID, and now? We're in a phase of euphoria masked as resilience. But here's the thing: cycles don't scream when they turn, they whisper. One lesser-known historical anecdote is the Panic of 1907, a crash so severe it led to the creation of the Federal Reserve. What triggered it? A failed short squeeze on a small copper company, not inflation, not unemployment. A single event in a fragile system. The lesson? It's not the size of the spark, it's the dryness of the forest. Today, the tech rally, crypto euphoria, and even real estate confidence might feel strong, but under the surface, liquidity is thinning. The smart investor doesn't panic when it breaks. They prepare when it bends. Let's talk about your mindset during drawdowns. When the market drops, the amateurs ask, "How low will it go?" The pros ask, "What is this business really worth?" That subtle shift changes everything. Peter Lynch once said, "Far more money has been lost preparing for corrections than in the corrections themselves." And it's true. Fear-based hesitation can cost more than a 30% dip. But here's where it gets powerful. The real edge is in buying while calm. That doesn't mean being reckless. It means buying when the numbers make sense, not when the headlines are happy. A subtle, sarcastic truth. If CNBC's front page is all green, it's probably already too late. Your edge is when it still feels uncomfortable. That's when prices disconnect from value. That's when the foundation for future gains is quietly laid. And speaking of purpose-driven wealth, that's what I'm testing right now. I'm building a Google Sheets command center. Something simple but powerful. It's designed to help you track your net worth, investments, income, cash flow, spending habits, and even your compounding progress, all in one place. It's not just a tracker, it's a strategy hub. The kind of thing I wish someone had handed me 10 years ago. If enough people want it, I'll launch it soon, and there'll be an exclusive launch discount for early supporters. You can join the early access waitlist using the link below. The tool will cost less than one bad financial decision, and that's the point. Let's wrap with a mindset shift that changes everything. Most people wait for a crash to start caring about risk. But the investors who win, they build their conviction long before the fall. They study companies, build watch lists, automate small buys, and review cash flow statements before the headlines turn red. They prepare when the market is quiet, so they can act when it screams. That's how you flip panic into purpose. It's not about predicting the next dip. It's about being unshaken when it comes. Because if you've built your plan, your watch list, your tracker, and your mindset, the crash doesn't hurt you. It hands you opportunity on a silver platter. and you'll be the one catching it while everyone else is running for the exit. That kind of confidence isn't built overnight. It comes from years of respecting your capital and training your perspective. Instead of asking, "What if the market crashes?" you start asking, "What am I building this for?" And that question changes how you react. You no longer see red days as losses. You see them as leverage. You stop comparing your portfolio to headlines and start measuring it against your personal vision. Most people only plan for gains, but the investors who win, they plan for setbacks. They expect volatility, and they have a strategy that thrives inside it. That's what turns average investors into long-term wealth builders. It's not flashy, it doesn't go viral, but it works. When the next downturn hits, you won't scramble to Google, "What should I do now?" You'll already know, because you saw it coming, and you built your fortress long before the storm. And there you have it, why the next market drop won't hurt you if you do this first. Remember, this video is for educational purposes only and does not constitute investment advice. It is important to conduct thorough research and consult with financial professionals before making any investment decisions. The value of investments can fluctuate, and past performance is not indicative of future results. Always assess your risk tolerance and investment goals before allocating your capital. If you found value today, I highly recommend watching my next video. Don't forget to like, share, and subscribe to our channel. Also, feel free to leave your comment below, especially if this video made you think differently. I appreciate your support more than you know. Until next time, stay consistent, stay patient, and stay winning. See you in the next one, Money Magician.